stay tuned to the end. We're going to start with a chart of the S&P 500 adjusted for inflation going all the way back to 1930. I want to separate this into two segments. The first 60 years and the last 30 years. You can see that if we start right here in 1930, or even if you went back to 1925 or 26, sometime in the 20s, we've got an average trend line of right around 400. And that just goes straight on through until we get to about 1990. And most people's time horizon for investing their money is, let's just say, around 20 years. So if we took any 20-year period here, starting in 1930, we go to 1950, you're going to lose money. 1950 to 1970, you got a little bit of a gain, but you're about to break even. 1960 to 1980, you're going to lose money. 1970 to 1990, a little bit of a gain, you're pretty much going to break even. That's why throughout this time frame, your average investor was really down on the stock market. They always thought that bonds were a much, much better investment, and you can see why. Moving on to today, we've got a much different story. Stocks have gone way up, they've retraced a little, and then they've gone way back up to now where they're at all-time highs. The chart from here to here is noticeably different than the chart from here to here. So what actually changed? Well, first and foremost, we went into a 40-year rate cycle where interest rates continued to go down. Number two, the money supply has expanded exponentially. Editor, throw up a chart of the money supply, and it's really shocking when you look at it. Number three is we've had quantitative easing on top of these artificially low interest rates that have expanded the money supply. The bottom line is from about 1990 to today, this entire market move was complete manipulation on the part of the Federal Reserve. And people who are stock market bulls, like I'm sure a lot of your friends are, they cherry pick. What they'll do is they'll just look at this time frame from 1990 to today and they'll say, whoa, look at how amazing this is. Even if you would have invested at the peak of the market, at the top of the bubble, you'd still be ahead. And they use this as some sort of mathematical proof based on history that you should always be invested in the market. And then they completely ignore this 60-year period, and they just say, oh yeah, nothing to see here, just don't mind that. So if we're going to use this time frame to project the future prices of stocks or what they're going to do based on history, why are we omitting this period when stocks did basically zero? If you make the argument to any of your friends or any of these financial gurus on YouTube that this entire move is a result of manipulation, they'll always come back and say, yeah, okay, it's because of manipulation, but you should still be invested in the market right now because the Fed can just continue to manipulate things. Well, Jeffrey Gundlach has a little bit different opinion on that. Let's go into a recent video interview that he did with Yahoo Finance, and I'll show you what I mean.
Step number two, let's dive into this shocking interview that Jeffrey Gundlach gives, and it's stiff drink time, guys, right now. So grab yourself a seat and buckle up.
In the late 80s, Japan was viewed to be invincible. They were absolutely killing it. The real estate was booming. They were by far the strongest stock market was the Nikkei in the world.
That sound familiar, guys? It's the exact same thing that we could say about the United States today.
And then the recession came in the early 90s, and the Nikkei got completely wiped out. And what's fascinating is here, 30 years later, it still hasn't come close to that high. Then,
just make sure you heard that. 30 years later, 30, it has never gotten even close to the high that it saw in 1990.
The OOs, it was Europe. In the late 90s, it was Europe with optimism that I think was misguided, but optimism about the euro. being potentially a reserve currency, and it was just formulated. It came into being in 1999, and it turned out that Europe was killing it and outperformed every other stock market region of the world. And then the recession came in the early 00s, and the Euro stocks got kneecapped, and they've never been back to that level again. Then you had the emerging markets with the dollar being weak in the middle of the 00s and the ascension of China. You had emerging markets were by far the strongest region in stocks in the world. And then when the Great Recession came, they got completely destroyed, and they've never made it back to that level again. So
now, guys, pay very close attention to this. This is where Gundlach is going to bring it back to the S&P and where we are today.
Where are we today? Today we have S&P 500 is killing everybody else over the last 10 years, almost 100% outperformance versus most other stock markets. My belief is that pattern will repeat itself. In other words, when the next recession comes, the United States will get crushed, and it will not make it back to the highs that we've seen, that we're kind of floating around right now, probably for the rest of my career.
The stock market will crash, and it won't recover for the rest of his career. Incredibly, incredibly powerful prediction. I really want you guys to let that sink in.
Step number 3, let's dive into the specific charts that Jeff Gundlach references in this video, and let's give you some actionable advice that has real world application that you can use to make more money. Starting with Europe, they reached their peak in prices in 2000, and it's been 20 years and they have not exceeded those prices. So not only would you have the opportunity cost, but you also would have lost a lot of purchasing power due to inflation. Moving on to the emerging markets, they reached their peak in 2007, and they've never come close to recovering. And finally, looking at a chart of Japan, which is my favorite chart to illustrate this point, you can see that at the top of their bubble, they were at 40,000 on the Nikkei. And today, the Nikkei is around 20,000, a 50% loss. But I also want to point out that if you lived in Japan in the 1980s, 1985, 86, 87, everyone in Japan, meaning the financial gurus and all of your friends, would have looked at the performance from 1970 to 1987, and they would have used that as a reason to continue to buy into the market at 30,000, 35,000, and even 40,000. You would have heard the exact same arguments in Japan in the late 80s that you're now hearing in the United States in 2019. So the big takeaway here, guys, is that markets go up and they go down, but they don't always go back up, especially after being in a huge bubble. So just because we're at the peak of a bubble right here in 2000, and we recovered and exceeded that bubble with an even bigger bubble, that in no way means that the next time this bubble crashes, that on a moving forward basis for the next 10 years, 20 years, 30 years, that we're ever going to get back up to where we were, not only today, but even going back to 2000. So my first piece of actionable advice is do not extrapolate. The past doesn't necessarily predict the future. And to be fair, this past doesn't necessarily predict the future as well, just as you can tell from 1990 to 2020. It's all about focusing on probabilities. If you would have bought the market here in 1980, the probability of you making money in the next 10, 20, 30 years was far greater then than it is now when you're buying the market at all-time highs. I'm not saying that if you bet with good probabilities, you're going to make money every time. That's not going to happen, ever. What I am saying is that if you continue to bet when the probabilities and the odds are on your side, over the long run, you will make money because it's just a numbers game. You're just like the house in the casino. Over the long term, because of the law of large numbers, they will always, always win. So then the next question becomes, well, George, if I can't invest in the market right now because it's at all-time highs, what do? I can't keep my money in cash, so I've got to have it in the market. You hear that argument all the time. As if the only market in the entire world is the United States market. Come on, let's think about this. Foreign stocks, gold, silver, commodities, rental properties, all of these things you can buy at very good prices. You could consider them cheap. You got to do a lot of homework, but there's tons of opportunity outside the standard S&P fund that all the gurus and your friends suggest that you invest in. Oh, and let's not forget about trucks. Those are my all-time favorite. If you really want a good play, go out and buy yourself an old school diesel truck. Getting back on track here, you may be asking yourself, well, George, how do I know if a market is cheap? Whether it's the United States market, S&P, the Dow, the NASDAQ, Japanese, Australian, emerging, whatever it is, I would suggest using the CAPE ratio. And I'm going to give you guys some homework right now. As soon as this video is done, I want you to pull up the CAPE ratio of the S&P 500, and you'll see that now we're way up around 30. But going back through history, if you would have invested around the time frames where that CAPE ratio was in your favor, you would have done very, very well. And I want to point out, it's not just me saying these things. It's not that crazy George Gammon guy, that tinfoil hat guy on YouTube. It's really experienced pros like Jeff Gundlach, Ray Dalio, Stanley Druckenmiller, and Warren Buffett. So if you're not going to listen to me, make sure that you're listening to them. For more information like this, check out this content right here, and I will see you on the next video.